Well, we run a value-oriented global energy fund. Where we're different is that we have done it for nearly 20 years. We run that with a team that's got nearly 80 years of portfolio management, finance or energy experience. And we deliver a product which is an equal weighted portfolio. So we have a number of equal weighted positions. So those attributes really make it quite different to the peer group in terms of delivering a sector strategy focused purely on the energy sector. So the fact is that we don't have any individual stocks that exemplify the approach. The portfolio is really a good example of the approach overall. So we run an equal weighted strategy. That means that maybe for the super majors we have at the minute the 14% weight to 4 super majors that represent probably 50% weight within the index as a whole. And from the point of view of value bias, you can see we run a portfolio on about 6.5 times EV/EBITDA for 2019 versus the index at about 7.5 times. So we run a portfolio. It's a balance of names as opposed to one individual name that really is a star pick for us. I think the process, the approach, it is always continually changing. The philosophy has been pretty consistent, value-oriented towards names that will do well within a strong energy market. On our process, we continue to do work on oil price sensitivity, and that is key for helping us understand balance sheet positions and to improve our stock selection. And we continue to do good detailed work on the macro analysis that is always changing. With respect to the portfolio construction, that's our thesis. Within the financial crisis, we allowed that to flex so that we didn't stick too rigidly to the underweight positions of the super majors. We will do what we have to do to look after the returns of the portfolio. And key really behind all of that is getting the macro position correct, and then the sector allocation, the super major weight and the stock selection will then follow thereafter. So we're lucky to have a long-term performance for this strategy, so nearly 20 years. So back to December 1998, since then, this is a strategy that has outperformed the index by 3 percentage points per annum over the entire period. The fund itself was incepted in March 2008 and is number 1 in the peer group since that point as well. So long-term, good numbers that we're very proud of. On the shorter term, over the last 3 years, oil prices have been on a downward trend. It has been against the energy sector. Our strategy has underperformed the index by 4 percentage points per annum. Over that period, we've been number 3 in our peer group of 7 specialist global energy funds. Over the slightly shorter term period, since mid-2017 or September 2016, when the energy sector troughed on both occasions, we've had good rallies and held a number 2 position within the peer group since those periods of time. I would very much hope so. That is the way that the fund has operated over the last 20 years. So we see a strong correlation between energy equities and oil prices. Bear in mind at the minute, sitting here today, we have about $75 Brent oil prices, which is fantastic for a spot price, but the long-dated Brent crude oil price still sits in the mid-50s. The long-dated oil price is that much more important in defining the valuation of energy equities. So if we see that mid-50 long-dated oil price move up, then we would expect to see energy equities react and move upwards as well. If the stock market were to price in $60 a barrel as a long-term oil price into energy equities, we'd expect to see probably 15 to 20% upside in energy equities. If the stock market priced in $70 a barrel as a long-term oil price, we would expect to see 40, 50, moving on towards 60% upside in many of the equities that we own.